Hi, and welcome to your investor update for April. I'm Shaun Stone, the Senior Technical Lead here at Nutmeg. And as we're continuing to keep much of our working remote in line with government guidance, I'm joined today by our Director of Investment Strategy, Brad Holland, over Zoom. Hi, Brad.
Hi, Shaun.
Let's kick off. It seems to have been an eventful year so far for investors. What did March bring?
Well, it brought good returns to the major developed equity markets, that's for sure, with global developed indices rising between 3 and 4%. And that finished off the first quarter with developed markets growing 5% and emerging markets, which fell in March, up 4% on the quarter. Japan and Europe, they showed the highest monthly gain, helped by currency weakness and growing confidence around economic reopening. Markets that lagged in 2020 have enjoyed a bit of a catch-up phase so far in 2021. That includes smaller companies that are expected to benefit from reopening after the COVID shutdowns. Bond yields rose in the US, partially retracing the falls they made last year under the emergency conditions. And that normalization process probably has further to run, and other bond markets are likely to follow, even though central banks are not expected to raise short rates anytime soon.
Is it still all about the vaccine rollout then?
Well, it's a lot about that, but don't forget Europe is not exactly doing great on vaccine rollout fronts. It's also about government stimulus policy. President Biden's 1.9 trillion package was passed and being quickly followed by a potential 3 trillion infrastructure package. This is all good news for the US economy, and well, good news for the US is also good news elsewhere, as global activity tends to benefit from a strong US. But the positive mood is about more than just a stronger US economy, though. The collapse in global trade that began in 2019 on Trump's trade war and accelerated last year by the lockdown, well, that's showing signs of recovery. We see that in the manufacturing and the construction cycles, in the fixed equipment investment cycles, and in commodity prices. So along with the reopening after COVID shutdown, there's also a sense of reinvigoration as various cycles are more aligned than they have been for several years.
So, given that generally positive outlook for equities, how does Nutmeg choose where best to invest?
Well, technology stocks benefited last year in part due to the shutdowns, but there are other reasons to remain positive on technology stocks. Now, first is profit margin, which is both wider and more stable in this sector. Greater regulation in this space will most likely trim these margins in the future, but they should remain wider than traditional industrial company profits. Now, the second reason is the fact that technology will now be more deeply embedded into all businesses. COVID has fast-tracked changes to work practices that could otherwise have taken generations to play out. The main way to access quality technology growth stocks is really via the US and China, which is why we continue to keep the portfolios slightly overweight in the US and emerging markets. As I mentioned, there has been a bit of catch up by other markets in the first quarter, and emerging markets actually fell just under 1% in March. But we think these themes will continue to play out for strong technology stocks in emerging markets and the US. Now, many emerging market countries have struggled with their COVID response, but we expect developed market economies to increasingly make vaccines available to the less wealthy countries. Nutmeg's views about improving global trade are another reason to generally favour emerging markets. One last area of interest is smaller companies. Now, despite the global recovery seen in economic data, there are gradual changes to global supply chains underway, driven by the US-China competition. At the margin, supply will become more domestically orientated. And meanwhile, government policy everywhere is intended to build up local economies. So both these factors point towards increasing exposure to smaller, more domestic companies.
Thanks, Brad. So, how have Nutmeg's fully managed portfolios performed in March?
Well, the high risk equity portfolio rose over 3.5%. Mid-risk multi-asset portfolios, they rose a bit above 2%, and lower risk portfolios grew less than 1%.
Were any changes made to Nutmeg's fully managed portfolios in March?
Well, I mentioned our thinking on the US, on emerging markets and small cap companies. So during last year, the portfolios benefited from an underweight in US small cap, but given the changes brought about by new government stimulus, we've moved to a more long-term neutral holding in US small cap.
Thank you. So this month's customer's question comes from Chris Carr, who asks, as the 10-year Treasury yields steepen in the US, putting pressure on tech, do you see this as a buying opportunity or a more fundamental rotation away from tech and higher, riskier valuations long term?
Well, thank you, Chris. That's a very fair question. It's true that lower bond yields make growth companies like tech seem more valuable in present value calculations. I've already highlighted why we're keeping our view positive on technology for the medium to long term. But as you mentioned, the rise in bond yields this year and really since summer last year is a key market event worth exploring. Now, we're viewing it as a sign of the re-emergence of normal conditions following last year's extreme lows in bond yields with the COVID policy response. Now, we have all seen the equity market confidence induced by this ongoing government policy effort. Now, this year, that confidence has migrated into commodity and bond markets, as well as into trades known as value trades. Now, value trades are investments that outperform when bond yields rise. Small cap companies are one of these. Europe is traditionally viewed as a value trade too, which may explain its 9% performance year to date. In the fully managed portfolios here at Nutmeg, we continue to favour tech stocks, but have recently, as I say, increased portfolio exposure more fully to small cap performance. It's important to stress that we don't view the rise in bond yields so far as being disruptive to asset markets. They remain below official inflation targets, for example, and therefore supportive of growth assets. They can deliver above inflation returns.
And thanks, Brad.
Thanks, Shaun.
And thank you for joining us. If you have any questions for Brad or the investment team, or something you'd like answered in next month's investor update, you can contact us via social media, email, or in the comments section below this video. We look forward to seeing you next month.